Namaste. Welcome to Business Valuation Revision Lecture. First, valuation. So, how do you value a company? The easiest way is to take market price per share and multiply this by number of shares. If you do not have market price per share, then we need to see if we have PE and EPS, because PE into EPS is market price per share. Okay. Next, suppose there is no market price per share, there is nothing, and you just have balance sheet. Then it is net worth that you need to consider, that is equal to assets minus liabilities, and in this liabilities we need to include contingent liability. Okay. Next, if I want to value a company based on cash flows that it will generate, then first see if there is any pattern that you can recognize in the cash flow. That means if the cash flow is same over the years, then cash flow is same. Then it would be cash flow for year 1 divided by cost of capital. If there is growth in cash flow, is growing at constant rate, that means for the first year it is 100, then assuming the growth rate is 10%, next it is 110 for year 2, then for year 3 it is 121, and so on. Okay, so it is growing at the rate of 10%. In that case, the value of business would be cash flow for year 1 divided by cost of capital minus growth. Okay. Next, so you are not able to find any pattern in cash flow, and there are irregular cash flows up to certain point, and after that point you see a pattern. Either the cash flow is same or the cash flow is growing after that particular point. So suppose for first 3 years it is 100, 105, 120. Okay, y1, y2, y3, and from y4 onwards you see a pattern. Okay, that it is growing at the rate of 10%. So 120 into 1.1, and y5 and all, it will be 120 into 1.1 whole square, y6 will be 120 into 1.1 whole cube and all. So how do you find the value? Okay, so what you do with respect to year 1, year 2 and year 3, just find the present value of these cash flows. Okay, after y4 you see a pattern, right? So there what you do, year 5 is 120 into 1.1 whole square, so on. So all these cash flows, you find out the present value using this formula or this formula, whichever is applicable. If the cash flows are same, use this formula. If the cash flows are same, use this formula. Okay, so here you can clearly see a growth of 10%, right? So what you do here, it will be cash flow for year 4 divided by cost of capital, that is weighted average cost of capital, minus growth rate. Okay, now you see that this is the value at year 3. Okay, you need to bring this to year 0 level. So if you see, how do you bring all these three to year 0? you will discount them, right? So how do you do that? You will do by 100 by 1 plus Kc. This will be 100 by 105 by 1 plus Kc whole square, and this will be 120 by 1 plus Kc whole cube, right? So these three you brought them to year 0. So this one is at year 3, right? So this one also you have to bring to year 0. So what do you do? This entire resultant figure you will divide it by 1 plus Kc power 3. So when you add all these when you add all these 4 figures, you get the value of business. Value of business. Okay. So when cash flow is irregular up to certain point and then it is constant or grows at a constant rate, then you need to follow this. Okay, so with this we are done with different types of valuation. One is market price. Then if market price is not there, then we will take PE and EPS, we will see if they are there, and then we will multiply to find out the market price per share. Then if we have to value it based on net worth, then we will take assets and we will subtract liabilities from assets. And if we have to value it based on cash flows, we will see that if you are able to find any pattern. If it is same, then you will take cash flow for the year 1 divided by cost of capital. If you see a growth rate, a constant growth rate, then you will value it by using this formula, cash flow for the year 1 divided by Kc, that is weighted average cost of capital, minus growth rate. Okay, and if you do not see any pattern up to a point and then later on you see a point, then individually you will find out the present value of those cash flows, then to the point from where you see that the cash flow is having a pattern, and after that, for this year 4, year 5, year 6 in this case, we will first discount it to year 3 level using these two formulas, and then the resultant figure will be discounted to year 0 level. Okay, so this is exactly what we have done. Now there are two things that I need to find out now. So everywhere I have used cash flow for the year 1 and weighted average cost of capital and growth rate. So how do I find out these? So first we will see how do we find out weighted average cost of capital. So weighted average cost of capital. Suppose this is the total capital and you have equity, you have debt, and weight of equity, let us assume it is WE, and weight of debt it is WD. So what would be the cost of capital be? Assuming I know what is the cost of equity and cost of debt, and cost of equity is denoted as KE and cost of debt is denoted as KD. So what would be the weighted average cost of capital, that is KC, is nothing but weight of equity into cost of equity plus weight of debt into cost of debt. Now let us find out what is cost of debt. KD is equals to, so what do the debenture holders get? So they get interest, right? So interest rate into 1 minus tax rate. Okay, because see, why do we have to multiply this by 1 minus tax rate? Because when you are reducing interest from your P&L, you are also getting tax benefit to that extent, right? So that is the reason we will also include, we will multiply this by 1 minus tax rate so that we will get true cost of debt. Next, KE, that is cost of equity. So how do you find out cost of equity? We will use the CAPM model. that is risk-free rate, that is RF plus beta into RM minus RF. So RM is market return minus RF is risk-free rate. So we'll use this. So this is how we'll find out the cost of capital. So now if you see, KC is found out. Now we need to find out the cash flow. So the very simple way, how do you find out the cash flow is, first let us first prepare a draft P&L. So first we'll take revenue minus cost of goods sold minus operating expenses, that is OPEX. Then you will get EBITDA, EBITDA. Then to this you will reduce depreciation. Then you get EBIT. To this you will reduce interest. Then you get EBT. Then to this you will reduce tax. You will get EAT, that is earnings after tax. To this, if suppose you have preference shareholders, you will reduce preference dividend. Then you will get earnings available to equity holders, right? What you will do to this, if you want to find out EPS, you will divide this by number of shares to get EPS. Okay. Now, so this is the P&L. But what is this earnings available to equity shareholders? This is EBIT. But we want to find out the cash flow. So we have to adjust certain non-cash items to this to arrive at the cash flow. Okay. If I want to find out cash flow to the firm, so firm level, I want to find out what is the cash flow. So I am least bothered about what is the capital structure, whether you have equity, debt, preference shares, whatever it is. I just want to find out cash flow considering, on a firm level basis. So what I'll do, I will take EBITDA into consideration instead of earnings available to equity holders, because up till here it is operating cost. After this it is all financing cost, and it is all financing cost, interest and preference dividend. Of course tax will anyway be there, we'll adjust for that even in this. So what I'll do, I'll take EBIT into consideration, EBIT into 1 minus tax rate. This is nothing but no PAT. Okay, net operating profit after tax. To this, what I'll do is, I'll add depreciation because it is non-cash item. Then I'll subtract capex, that is capital expenditure. I will subtract if there is increase in working capital, and I will add if there is decrease in working capital. Okay, so with this I will get free cash flow to firm. This is nothing but FCFF. Okay, so you found out how to get FCFF. Suppose there are abnormal gains and losses. So what I'll do, I'll adjust for them, because see last year I have there was a fire accident. So because of that I had to incur some losses. All those things I don't expect them to continue in future as well, right? So that is an abnormal loss. So items like these, what I'll do, I'll adjust it to EBIT to get adjusted EBIT. So what I'll do is EBIT plus abnormal loss minus abnormal gain. We get adjusted EBIT. So in this case, I will take this adjusted EBIT and I will multiply this by 1 minus tax rate. So instead of EBIT, I will take adjusted EBIT, and then the entire process will be the same. Suppose I want to find out what is free cash flow to equity holders. So this is free cash flow to firm, right? So what I'll do, this entire thing, I will bring it here. All these adjustments plus depreciation minus capex minus increase in working capital, or if it is decrease, then plus decrease in working capital. This entire thing I will bring it here, and then I'll get FCFE, that is free cash flow to equity. So suppose if there is abnormal loss or gain in this case also. So what I'll do, this adjustment whatever is there, I will do it here, and I will get adjusted EBIT, and to this I will continue the same. Like I'll subtract interest, I'll subtract tax. So I'll subtract tax, and the entire thing will be the same. So this is how we will find out free cash flow to equity and free cash flow to firm. If we are using free cash flow to firm, then we will discount it using weighted average cost of capital to find out the firm value. If it is free cash flow to equity, then we will discount it using cost of equity to find out the equity value. Okay, so this is done. Next, now that we found out what is the value of the company, so suppose I want to acquire one company, okay, and I want to acquire one company, and there is a target company that I am going to acquire. Okay, so market price of acquirer is A, and market price of target company is T. Okay, so number of shares of acquirer company is X, and target company it is Y. So if I have to find out how many shares should the acquirer company give to target company, number of shares to be issued, then what I'll do, first I'll find out the value of target company, that is nothing but T into Y in this case, that is wait, that is T into Y in this case, that is market price of target into number of shares of target company divided by market price of acquirer, right? So this is how I'll get number of shares to be issued. If I have to find out the exchange ratio, that means I have number of shares, okay, number of shares of target. What is the exchange ratio? So that I can multiply that exchange ratio to number of shares in order to get number of shares to be issued. So here what am I multiplying with? I am multiplying this number of shares of target with market price of per share of target company divided by market price per share of acquirer, right? This is how you will find out the exchange ratio. Okay, next, suppose I have a capital of 1 lakh and the weighted average cost of capital is 18%. So what is the return that I generate? It will be 18% of 1 lakh, that is 18,000, right? So, but my net operating profit after tax is 20,000. Okay, 20,000. So that means I am generating more than the required return. So what is this excess return? It is 2k. This excess return is called economic value that is added, that is EVA. So EVA, this economic value added, is nothing but NOPAT, net operating profit after tax, minus weighted average cost of capital, or you can also write as KC, okay, into total capital. Okay, total capital. Right. So now in this case, in this example, what will happen to the value of company if I am generating excess return over the over and above the required return? So obviously the firm value will increase. So if I have to give dividend and ensure that the firm value will not reduce. Okay, so what is the max dividend that I can give? So the maximum dividend that I can give to ensure firm value does not decline is this economic value added, right? So economic value added, that is the max dividend that I can give, divided by number of shares. Okay, so this is all with economic value added. There is another concept called market value added. So what is market value added? So you have an equity fund in your books and your market value is uh, over and above, your market value is greater than that equity fund. So the amount that is the excess amount that is over and above this equity fund is called market value added. So MVA is nothing but market value of equity minus equity fund. So what is this equity fund? It is nothing but equity plus reserves and surplus, right? So with this we are done with revision.